On yield now, viewers, at 4.66%, continues to notch highs, at least the last year or so. This is the highest we've seen the US 10-year bond yield at. Let's discuss that and more, right? Manpreet Gill joining us, Chief Investment Officer, Africa, Middle East and Europe at Standard Chartered. Manpreet, great having you, and thanks for coming in. Let me first start off with that, right? The risk of crude. When we were speaking with most analysts, they suggested that the oil shock may not be as exaggerated as was the case a couple of months ago when this dispute first started. How should one look at crude and oil prices now, given the recent bit of escalation that we've seen?
No, good morning. You're absolutely right. I think oil is the key variable in today's markets. But I think there are two factors that might be helpful in forming a framework here, right? I think number one is just trying to think in terms of recent disruptions and how they balance off inventory levels. Because even in the broader conflict earlier in the year, it was inventory that really helped avoid a broader price shock. And some of them obviously were depleted in Q2, and then some of the supply, that did get out over the last, during the ceasefire period, helped offset that to some degree. And the second, of course, is just thinking in terms of at what point do oil prices become a constraint? Because, you discussed the 10-year, US bond yield. We think, obviously, the global economy, the US economy, equity markets can tolerate oil prices up to a certain level. But where the inflationary shock starts to become more significant, or where they could trigger more significant market volatility, we think, as they did for a large part of this year, we think that, of course, can ultimately act as a constraint. Short-lived spikes, of course, are always possible, but we think the length of time oil spent at high levels is really the key.
Manpreet, I was looking at your last report, and you said that India and China equities to benefit from broadening of the rally. Do you think that rally may be short-lived because crude is now spiking again?
I'd actually turn that on its head because, yes, we do think there's room for the rally to broaden. But I think that's really triggered by our views on the equity rally, the fact that it's been extremely narrow and led by semiconductors. So in Asia, you can see that's entirely with Korean, Taiwan equities. And we think even a modest broadening of that rally can benefit Chinese and Indian equities. The thing with energy prices, though, is it's more of a binary variable. It can be a headwind in the short term, as indeed we seem to be in at the moment. But in the broader picture, let's not forget that if we go through the period where we had the initial sort of ceasefire MOU, oil prices moved to 70. Our view was always that, look, these things rarely move in a straight line. We expected an average of 80 prices, and obviously in the short term trading in a range around that. So I think that so far, obviously, we're testing the upper limit of that, but I think that's the environment we seem to be in at the moment. And I think that's giving markets, some comfort, at least for now. But I think the point here is that, look, that rotation rally, we think, is more driven by what's going on in the semiconductors and the fact that those obviously run far ahead of the other markets. So it's about how the two factors offset each other, that, rotation, the broadening rotation versus, obviously, oil prices can be challenged in the short term. But a short-lived, obviously, spike in oil prices should not derail that broadening rally. That's a longer-term factor over the rest of this year.
Still maintain that dollar is going to weaken going forward?
On a 6 to 12-month basis, yes. And to some extent, we see these all being a related trade here, right? Because when you think about higher bond yields in the US, that is, of course, what's propping up the US dollar. And that's ultimately stemming from the worries about inflation, whether they're justified or not. So look, we do think those can support the current sort of range-bound dollar in the short term if you're thinking about the next month or two. But once you look beyond that, unless you're talking about a trajectory of oil prices sort of trending higher, which is not our base case, we think that ultimately, as you start to see oil prices not make new highs, I think some of those inflationary concerns can start to recede, and that we think will ultimately unlock that dollar weakness. Remember, it's not just about where U.S. yields go, but it's a relative argument, and we do see yields rising elsewhere in the world. And Japan's a good example of that, and I think that relative argument, even if it trims the dollar's advantage to a modest degree, can help restart that modest dollar weakness cycle.
how should one look at Indian markets in the context of what's playing out globally from a tech perspective? Indian markets haven't been favored by the global investor. Do you see that turning? You've got good visibility of how things are playing out. Do you believe that that cycle will likely turn? And if so, how quickly? Timing, factors, give us a sense.
So yes, we still think that Indian markets can benefit, but I think it comes to what you were discussing about that broadening trade, right? Because look, no doubt when you go through periods of high oil prices, we did early in this year, we know that's a headwind for Indian and indeed many specific Asian equity markets in the short term. But I think the other leg that has, to some extent, deliver that relative underperformance of Indian equities is the fact that it's the semiconductor focused markets is where all the flows have gone. So when you look at Asia ex-Japan equities, yes, as a region, it's done very well, but that's pretty much been entirely focused on Korean and Taiwan equities, which we know are very semiconductor sector heavy markets. So independent of what happens to oil prices, we just think that as you start to see a broadening of that trade, we still think semiconductors should do well, and we're sort of maintaining that overweight on Taiwan equities. But we start to think that at some point you need that gap between those markets and the rest to catch up, and you can take a sector sort of view of that. But we think if that rally starts to broaden even to some degree, then Indian equity should be a beneficiary of that because obviously Indian markets offer broader sector exposure that have relative to the region underperformed quite a bit in the earlier part of the year. So that's really what we think will ultimately support gains. Obviously, we need to get through immediate short-term headwinds of oil price worries and obviously that elevated dollar. But we think once both of those start to recede, that of course can provide the catalyst.
Manpreet, in this entire scenario, what we are missing out is how the yen has crossed 163, and there is now a growing apprehension of a faster rate hike that may come in Japan. And if that happens, how does the entire scenario changes?
No, it's a really good point because whether you're looking at Indian equities or any other sort of major market, a weak yen continues to be a great source of liquidity, right? It's everyone's favorite carry trade. And from a Japanese policymaker perspective, it's understandable that continuously weaker yen may not be something they prefer. I'd argue some of that is also a result of the fact that in recent months we've also seen the dollar hold up much more than we certainly expected at the very start of the year, and a dollar yen it's coming from both sides. But equally, a short, sharp move in dollar yen may not be in everyone's interest either, because that, of course, can have knock-on impact on liquidity across many major markets. So, look, we certainly think it's something to worry about or keep a focus on. We've always held the view that the dollar yen's, quite likely to move back into the 150s, whether that's driven by some form of policymaker intervention or just expectations of where interest rates go. I think the reason, dollar yen, we think can move to the 150s, but perhaps not more than that, is that the absolute gap between US and Japanese yields at the moment is still quite wide. At some point, depending on Japanese policy, what the BOJ chooses to do, that could start to get a lot narrower. But sitting here today, we just think that the Fed, in our view, will sit tight and leave policy rates where they are, and that leaves quite a bit of room for the Bank of Japan to hike rates before that gap starts to come uncomfortably narrow. So I think in the short term, it's quite possible that whether it's verbal intervention or otherwise, we sort of see moves back into the 150s, but I think at a broader level, I would worry less at this stage simply because of the wide gap that continues to exist between Japanese and US bond yields.
Manpreet, one more thing that I wanted to discuss with you before we let you go is on this entire AI CapEx, because, I mean, look what's happened with Alphabet. Even though their cloud earnings have managed to beat estimates, but the fact that they've actually raised their AI CapEx guidance now to $190 to $205 billion, that's actually not going down well with this trade. Why is it spooking investors?
No, it's certainly the area of focus at the moment. And I think some of it is simply where the numbers are coming out relative to expectations, right? And the broader context here is that, look, in the last few quarters, we've been in a world where a lot of CapEx is funding out of free cash flow. And for that group of companies as a whole, of course, we're now starting to see more and more of that, be funded by debt. Now, at some level, in the short term, it's natural for there to be concerns. I think it's ultimately not so much about absolute, but where these numbers end up relative to short-term expectations. But at the moment, we certainly feel that that at a fundamental level, these sort of capex levels and the levels of debt, more importantly, that these could imply are certainly at comfortable levels. So we may see some volatility because expectations have been reset. But looking beyond that, we actually think that some of today's price levels actually may offer an attractive opportunity where an investor may be looking to build some exposure. I think longer term, there is obviously the concern about how far does this go, and could debt levels reach a point where they start to become a genuine concern. But it looks like we're quite some distance away from that. If you take a bond market view for a moment, those that are using debt, at least the larger hyperscalers, still sort of qualify as very high quality investment grade companies. So while we're having a debate on the extent of supply in investment grade bond markets, it's certainly not a conversation about credit quality. So I'd see that more as a short-term reset of expectations, but from a fundamental perspective, this could very well provide an attractive opportunity.
Interesting. Manpreet, great to chat with you. Thank you so much for your time today.
Thank you.